You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the Chief Investment Strategist for Institutional Advisors. Welcome to the show, Bob.
Jim, good to be with you, and it's always good to be with you because it happens on a Friday.
How have our markets treated us this week?
Well, we've had the rally out of, you had where they pulled the bid out of quite a few things in October down to the middle of the month, and we had, for example, on the junk bonds, we're down to what we call a springboard buy, and it just, exercised itself on the way down and then bounced up. Now, this veteran trader would have thought that you might retrace 3/4 of the give up. And by the way, on the S&P, it was sort of like a 10% correction, a little less than 10%. But RUT, the Russell, and the European stock index, it was a larger decline. But at any rate, you were getting a natural bounce, and then the European Central Bank said it renewed its vows to boost the stock market. Then the market then the Bank of Japan came out and it did another one of its, 5% depreciation of the yen efforts. And then you had the market starting to discount the political change in the U.S. on their election on November 4th. So then the other thing that came in, and it was also that the talking heads on TV immediately got, and as the bounce started in the middle of October, that's it. We've now on the seasonal strength from October to May. Now, May is a long ways away. So anyways, this is all now good stuff in the market. And you've had the senior indexes like the Dow, the S&P, and the NASDAQ go up to new highs after quite a shakeout. So then we want to go over and look at what's happening in the credit markets. And as I mentioned, that the junk JNK in the middle of the month got down and generated what we call a springboard buy. Up it went, and in a week's time it had bounced back so far that it generated the opposite, which we would call an inverted springboard. And now JNK has been quietly declining against a declining 50-day moving average. It's not looking so good, and we should remind ourselves that JNK set its high back in June with pretty good momentum, and it was leading on the way down. The Russell 2000 set its high around that time as well, and was leading on the way down. And then, of course, our friends over in Europe, the stocks, STOXX, sorry, let's do that one again, STOXX, composite index of European stock exchanges. It was also declining since June, July, and taking out key moving averages. So these, the Russell and the stocks were leading the correction that came here. So anyways, these have bounced up as well, but not as far. So when we tie it in with the action in J&K, these are kind of sort of running out of energy here. And the junk, it's declining in price, increasing in yield, and relative to what's going on in the yield of the long treasury. So that gets us into the credit spreads, the difference between high grade and low grade bonds. So our friends over at Fred, which is the name for the Federal Reserve at St. Louis, who have a very good chart site. Anyways, Fred's telling us that spread between long-dated treasuries and below investment-grade bonds, it continues to widen, and that started to widen back in June. And by stages, it's widened out, and it's now stepped up to be wider than it was in the little let's get out of here selling mode into the middle of October. So we're looking at that as a warning. The other thing that has been absolutely fascinating is the collapse in crude oil prices. except for today, we're getting a nice bounce out of it. And go back into the summer in that one, where you had the oil stock side in North America was doing very well because of the additional reserves being added up through fracking, drilling, and all that sort of stuff. So it was doing very well, but the XLE, which is the ETF for the U.S. Oil patch stocks, got up to a terrific rally and generated an upside exhaustion in our work, and then on another one, a pattern which we call a sequential sell. So that was in July, and they'd come down quite a bit before September, where then the crude oil price, which had rallied up to, 107 in June, and it wasn't doing much during the summer, and by the time it got to late September, all of a sudden, boom, down it went. And the other part we've been talking about on this show and writing about was that back in the early 80s with Reagan, and he wanted to defeat the Soviet Union, and there was a side deal worked out with Saudi Arabia, then the biggest producer, such that on a cyclical decline, a normal decline in crude oil prices, they would not try and slow the decline. So the result was in 85 to 86, late 85 into early 86, price of crude, which I think had been in the order of $35, was about 31 in November, December of 85. Down it went to $10, I think, by March of 86. So then that took the reserves income, the hard money flows into Russia. It canceled it, and they ran out of money, and then that was part of the business of ending the Soviet Union. And then now, and I was just reading one here the other day, that, and as I say, we were talking about this one since last summer, that it would be ideal if the price of crude oil took an unusual decline and then deprived the Putin, who I call him a neo-Soviet, with the necessary revenues to conduct his aggressive policies. So this is happening, but also here, just reading recently, the Saudis are very wary of the Iranians and also ISIS. So they perhaps would be interested now because of their own neighborhood, in allowing crude oil prices to fall further than, say, an ordinary cyclical decline would merit. So, energy patch, we did get a quick, brief rally out of natural gas on the discovery of the recent wave of cold weather in North America. But it didn't hold. It just it was a good rally, got overbought, and then with the collapse in crude oil prices, the natural gas obviously went down. On other commodities, the side that we thought for the last few months that had the best chance of recovering a little has been the grains. The symbol is GYX, and it set a low and sort of based the saucer bottom, and then has recovered, not bad. But this perhaps now is vulnerable too to problems in commodities.
Bob, if there's a drop in the price of grain, does that mean we can see lower prices for alcohol?
Beer, yeah, it should be, except there's too many middlemen in on the beer deal by the time it gets to your glass.
Yeah, it is. It's all tax. It's all tax.
But now, we're looking for a low in copper can have a seasonal low in November, and crude oil can have a seasonal low in December. So we're looking for potential lows in here, but we are wary on the crude oil side. Should it do what it did in 1985-86, like decline enough to deprive the bad guys of reserve cash flow dollars? So
yes, I mean, one of ISIS's biggest sources of funding is the illegal sale of oil to people who will buy anything at any price.
That's right.
We'll be talking gold and silver when we return with Bob Hoye.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. I'm Jim Goddard. We're talking to Bob Hoye, Chief Investment Strategist for Institutional Advisors. Bob, what's happening with gold and silver?
Well, we're getting closer to a significant low for the sector. We should go back to last year, at this time when we were looking for commodities and gold and silver to kind of set a low around December and then rally out into the spring, which is what we got. And on the gold side, there were some fabulous rallies. One stock we followed closely, which was about $1 or $2 in December, did get up to what was it? $1.90 in May. But on that rally there, we used the silver-gold ratio to determine the amount of speculation in any move for the sector. And because on any rally for the precious metals, silver will outperform gold, and then when you get close to the top, they get pretty excited about silver. So we used the momentum on that one, the RSI, and in the spring it got up to 84 on the RSI. And that is high, and we noted that it was dangerous and people should take some money off the table. So that was our last stance there. So now, more recently in September, we thought gold shares and silver stocks could decline into late October. And then in the middle of October, we thought, could go a little further. But in the last 2 weeks of October and into the first week in November, these things fell pretty hard. So, did a special study on gold a week ago and said we're looking for a bottom now. And we had on our technical work downside capitulation on silver, the metal itself. But, when looking at, this has been a bear market since 2011, and it's been a nasty one. So you look back at previous nasty bear markets for the sector, and we want to be a little cautious here instead of just wailing right in and saying, this is it. So what one wants to look for is that typically at a bottom, also at tops, the gold stocks lead the move in the metal prices. So it's only been now since, November 3rd, when the gold shares, and we're using the Hoye because it's had a long record, relative to gold has started to move up. And it has done a nice bounce up. Now, some of the stocks have had nice bounces as well, but they're checking back a bit to yesterday. But what we're looking for here is stability in gold stocks and then moving up relative to gold. Now, we did that yesterday. The Hoye divided by gold back to a really bad one, bear market, was down into 2001. And the ratio went from 0.44 then down to 0.13. That's the ratio between Hoye and gold. And it became very oversold, but it took a few weeks of being oversold before it really turned around. So then looking at this latest slide, the numbers are quite similar. I think it was around 0.44, in the spring. And then it's been coming down, and the same number comes in at 0.13. So looking at a double bottom, although, 2001 was a long time ago. But it's also very oversold on the RSI, I think down into the low 20s. But our view here is that we are in the right conditions for buying, but one wants to be careful because at previous lows like this, it can take a number of weeks to actually find the bottom instead. So we're content to let somebody else set the bottom, and then once it's stabilized, then one should pick up the buying.
And Bob, before we go, we have a question from Bert in the Netherlands, and we've answered some of his questions before in the past. So what has Bert asked you, Bob?
Yeah, well, actually, I'm going to put in that it's good to hear from Bert. Here's what he writes. The U.S. dollar is up versus the other currencies. This is probably caused by investment demand for U.S. securities. I'd agree with that one. The dollar price of gold is reacting inversely to this dollar strength. But we still have another wave of U.S. dollar strength in store when we get the next phase of the credit contraction. Will this be the tipping point where the U.S. dollar and the dollar price of gold will both go up? And what does it take to start such an event? Wow, that's something, Bert. The whole of the gold community has been trained for decades that gold, you need a weak dollar for gold to go up. And there are times when you've had the weak dollar and gold has gone up, But other things like crude oil have gone up much faster than the price of gold. So then, and when you consider gold as crude oil as a proxy for energy costs, mining costs go up. So as we like to say, if you want to speculate in U.S. dollars against gold, do that. If you want to invest in gold shares, you want to look at the real price and profitability. But I'm not prepared yet to get in. I think you can get a period where you could have a quietly rising dollar. That would be because the Fed cannot depreciate it as it wants. Also keep in mind that with the Republican majority, there will be less approval of out-and-out recklessness by the Fed. So their ability to depreciate the dollar may be diminished. So, but if you look at the real price now, it came all the way down from 2009 as the boom. You had the price of most everything was going up relative to gold. So, and particularly commodities. So it came down to what we take as a cyclical low in June of this year, and it's been recovering ever since, and might have stalled out here recently, but it's enough to say that it's a very solid uptrend. And this is appropriate because it reached its low at the real height of the boom, including credit markets, because the credit markets reached their best in May and June, and that's when gold reached its lowest relative to commodities. So this underlying is improving the profitability of gold mining. And eventually the stocks will respond to it. But in the meantime, you have liquidity problems from time to time in the credit markets, and you had a liquidity problem in the stock market in the middle of October. And these liquidity problems are not going away. And as we talked a few minutes ago, the credit spreads continue to widen. That's saying that liquidity is diminishing. So, yes, at some point you could have a quiet rise in the U.S. dollar, and the investment demand for gold would be such that it could even move up in dollar terms, which speculators there might like. But we're content to stay watching the real price of gold and its potential influence on improving profit margins. So, and also just to wrap the gold up, we want to see the gold stocks stabilize and then start a good upturn, and then one would have much more confidence in getting positioned. Also, for those that want to own gold directly, you can do that and forget about the price in dollars because it's an uptrend in purchasing power. So we can do more of this next week.
Bob, always fun talking to you.
Always good to be with you on this one.
Have a great weekend.
You too. We got great sunny weather here in Vancouver.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. You can find their website at institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. You can forward comments or questions to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.